Hey guys, here we are with a quick review for Chapter 4, Accrual Accounting Concepts. You can see that this chapter starts with a group of really happy students, and then this guy in the middle, I don't know if he's the boss or the teacher or what he is, but the folded arms make him look powerful. And, well, I don't know what else it makes him look like. I'm moving on because this is quick review. So take a look at the learning objectives. This is all about accrual accounting. Remember that confusing stuff where the cash doesn't always match up with the activity. And remember the basic concept behind all of this is that in modern accounting, what we want to do is we want to record transactions when they occur. So revenues when we earn them, expenses when we incur them, but that doesn't always match up with when we receive cash. Sometimes we will do the work and then receive the cash later. Sometimes we'll receive the cash ahead of time and then do the work, etc. So that's the broad concept here in this chapter. And that's what they mean by the revenue recognition principle. So I won't spend a ton of time on it other than to say, make sure you review the blue terms, which I tell you every time, so you're probably getting sick of hearing it, but it's the truth. And then read through this chapter on revenue recognition principle, the idea, again, that sometimes we receive money in one period and don't earn it till the next, or vice versa, we earn it and then receive money later. All of those sorts of things matter in an accrual accounting system. We want to record the revenue when we earn it. We want to record the expenses when we incur them, regardless of when the cash moves. But that leads us then to, and this kind of explains all that a little bit better too. So that leads us to this need for adjusting entries, because sometimes we, when we do that, when we receive the money before we've earned it, we've got to record the earning of it later in another period. So there are 4 types of adjusting entries: 2 deferrals, 2 accruals. The 2 deferrals are prepaid expenses. That's where expenses are paid in cash before they're used or consumed. The most common idea behind this would be prepaying rent or insurance, say for 6 months or for a year. And so that's a deferral. We pay the expenses ahead of time. We record them as an asset, a prepaid rent, as an example, asset. And then each period, at the end of each period, we have to do an adjusting entry to show that we're using up some of that asset and incurring the expense of rent for that period. The other deferral is an unearned revenue. That's where cash is received before the service is performed. So that's when a customer will pay us. This happens a lot at my storage. People will pay me in advance for a month or a year, or not a month, but for a year, say. And so I have to record that as a liability that I owe them the use of the facility now for a year. And then at the end of each period, usually at the end of each month, I record the liability decreasing, unearned revenues going down, and my revenue increasing because I've now earned the money for that month. And we also have the accruals. So there's the accrued revenue. That's where revenues for services performed but not yet received in cash or recorded. So when we perform that, we record the revenue, and then we record the adjustment when we get the cash later. And the accrued expenses incurred but not yet paid in cash or recorded. Same concept. Okay, so make sure you're very familiar with these. That's a list that they're going to use in a test, and you're going to see it. There's the trial balance, which we talked about last chapter. After we do the adjusting entries, and usually that's where they give you additional information, and then you have to do the adjustment. You better get very familiar with these. You're going to see them on a test. They're always on a test. So they give you a bunch of examples in the book of different types of adjustments. And then after you do the adjustments and do all of the adjusting entries, that leads you to the adjusted trial balance. And all that is you take the trial balance, and then if you make adjustments, adjusting entries, those are going to change the balances in some of your accounts. And so you update the accounts with the new balances and create the adjusted trial balance. The adjusted trial balance is important because, number 1, it helps us make sure our debits and credits balance. Number 2, it gives us all the info now we need to create our statements. You can see here's the balance sheet accounts, assets, liabilities, the equity accounts, then the dividends, which we can use for the statement of retained earnings, then the revenue and expense accounts for the income statement. So it's really important. So it's all there. So if you're planning for a test, I would say the biggest takeaway from this chapter, if it's a takeaway, is that you need to understand how to do the adjusting entries. Okay? The last thing in this chapter is the closing entries. And remember, that's the idea where we, at the end of the period, we want to take our temporary accounts, the revenue and expense and dividend accounts, and return them back to zero, and do that by posting all of those over into the permanent accounts. So the way we do that is we close our revenue accounts to an account called income summary and our expense accounts to an account called income summary. That will leave us with some balance. If there were more revenues and expenses, we'll have a credit balance. If there were more expenses than there are revenues, we'll have a debit balance. We'll then close the income summary account out to retained earnings. And by close, what I mean is we return that account to zero, if you remember that. So if our revenue account has a $1,000 credit balance, we would close that to income summary by doing a $1,000 debit entry, which would now leave the revenue account with a zero balance. And then because we've done a debit in revenue, we'll do a credit to income summary of $1,000. We do the same with all the expense accounts, except they will have debit balances. So we'll do credit entries to return those to zero, and we'll do debits in income summary. The balance there will like I said, either be a credit balance if our revenue is greater than our expenses, or vice versa, a debit balance if our expenses were greater than our revenue. Then we'll close that to retained earnings, and we'll close dividends straight to retained earnings, and that's the closing process. There's a general journal of all of the closing. All right. So like I said, the biggie, the most important thing for you to know how to do for any exam or just for you to take forward into the rest of the course is to know how to do these adjusting entries. Know that there are 4 types of them, 2 deferrals, 2 accruals, and then make sure you understand the concept so that you can do the adjustment for each of these types of things: prepaid expenses, supplies, which are assets that are used up over time, insurance, which is another prepaid, depreciation, which is, remember what depreciation is, that's the allocating of cost over the life of an asset. And so each month we have to recognize we're using part of that asset, and so we record it as depreciation expense, and so forth. So be very sure, again, there's plenty of practice doing these in the assignment work and in other areas within the course, but mostly in the assignment and in the exam preparation stuff. Make sure you're comfortable doing adjusting entries. And like I said, the textbook actually does a good job in here of breaking down each one of these transactions and showing you how it works. All right, so that is the quick review for Chapter 4. Again, if anything, make sure you can do adjusting entries, and make sure you understand, all of the terms, and you should be great.